In this recording, we'll look at problem 1, using it as a problem to demonstrate the income statement. So here's the information for problem 1. This is right out of your textbook, whether you're using the ebook or a physical textbook. Here's the information. And it asks us to write out a multi-step income statement, which is the most commonly used form for the income statement, and then also retained earnings statement. So, if we go through and sort all this, you're going to find the basic sales revenue, cost of goods sold, and solve for gross profit. And I've gone ahead and looked at that and listed those kind of things out already. So, we're going to see, our first income item is gross profit. So this shows various kinds of income. So gross profit, we have the selling and administrative expenses. Those are operating expenses. A lot of times I call it that instead of as selling and administrative. So first section, we arrive at income from operations, which is our operating income. So again, if I were to look at sections of the income statement, this first section describes the core operations of the business. So income from operations. And then the remaining part, when I get down to income from continuing operations, are really the non-operating items. So these are not the core activities of the business, but they're frequent enough to get mentioned, but not an ongoing sort of thing. So we have our primary operations of the business, and then we have our secondary, which we will label as non-operating. Okay, so I've just gone through and pulled these items, the dollar amounts, income from operations, and then we have the section for non-operating, where we list secondary sources of revenues and then gains and losses, secondary type of expenses and losses. So these are non-core sort of things. So interest revenue down here in expenses, if we had interest expense, that would be listed here as well. So the kind of things, interest revenue, interest expense gets listed down here. Gains and losses, so gain on sale of investments, if that had been a sale of property, plant, and equipment, that gain or loss would be listed there as well. So loss from flood damage could be loss from sale of property, plant, and equipment. That loss would go right here as well. Write-off of goodwill, if the company restructures itself and it has costs incurred for the major restructuring, that expense or that loss would go here as well. Okay, so I list all of those out, arrive at our income from operations before income tax, arrive at our income tax expense. This is given. Typically, though, we're given a rate. We could figure out what that rate would be, because if this company is paying $1,244,000 of taxes on $3,270,000 of income, if I divide 1244 by this 3270, I'll get an income tax rate of 38%. So typically I know the 38%, multiply that times this 3,270,000 to get the 1244. Okay, then income from operations, it gives us the income from continuing operations. Then we have an item here at the very bottom of the income statement, something that is not going to continue. So this is put at the very bottom because it's informative, but if I wanted to use the income statement to project future income, I would not include these discontinued operations in my projection. So this is going to get put at the very bottom of the income statement. These items get shown net of tax, the $90,000 and the $440,000. And let's talk about discontinued operations for just a minute. On page 164 of your textbook, it talks about discontinued operations. And you can imagine just by the name, this is a part of the company that the company is stopping. It's discontinuing it. But to meet the category, it has to meet two criteria. It has to be a component of the business. And you have to be able to distinguish the component, and that's kind of, duh sort of thing, obviously. We'd have to be able to distinguish it if we're going to account for it separately. So we have to be able to account for it and report it separately. So the records have to be distinguishable so that I could pull out this whatever this component is, pull it out from the rest of the company to be able to report it. The other thing is that it has to be a strategic shift from the company. And so here, it says strategic shift generally includes the disposal of a major line of business, a major geographical area, or a major equity method investment. That last one probably is not going to make sense to you at this point in time. Probably when you get into advanced accounting it will. But if you think about it, equity investment means a stock investment in another company. So if I've got a major stock investment in another company and I'm getting rid of it, discontinuing that, then I would report it as a discontinued operations. But again, it would have to be major, not just some investment in another company. Okay, and so those two things have to be met, and then we actually are going to report a couple of things about it. So down here, we will report the gain or loss on the disposal of the component itself. But in addition, we want to separate for the year that or whatever the time period is that we're reporting, we want to show the results of the operations for the component alone. So for our financial statement, our income statement in problem 1, we're reporting for 1 year. So we want to show, what were the operations of that company for 2017 or whatever year it is that we're reporting. What were the operations? What was the profit or loss on that? And then up to the time of disposal. So what was the profit and loss just on operating that component up till the time of disposal? And then secondly, on the date that we dispose of it, what was the gain or loss? So we can see this company here in problem 1, going back to it. It had a loss. It did not have profit. It had a net loss on its operations. And then when the company sold this component, it actually had a loss on selling that or disposing of it. I'm going to come back to this net of tax thing because we're going to see, because we have already solved for income tax expense up here above, this income tax expense does not factor in the tax impact of these two items down here. So we have to show the tax effect separately here for the discontinued operations. Okay, so then I net those two losses together, deduct that from income from operations, and then I have my net income. So let's stop for a minute. I want to talk about this idea of income tax allocation. So let's turn our page and look at these two items. In this particular problem, it tells us the loss from operations after the impact of taxes is $90,000. We also had construed that the income tax rate is 38%. So we know $90,000 is the loss itself minus the income tax, I'm just going to abbreviate that real quick, income tax benefit, right? We get a benefit if we have a loss, so it reduces our taxes from that. So that means we would have the loss, but we also get a 38% benefit from that loss. Because if I solve for the tax impact, I take 38% of whatever the loss. If this had been a gain, I would be paying tax on 38% of the gain. Okay, so that means then 100% minus 38% is 62%. So $90,000 is 62% of the loss. So if I want to, solve for it itself, the loss itself, I'm going to divide each side by 62%, so that will cancel out. 90,000 divided by 62% gives me 145,161 is my total loss. And then again, if I take that times 38%, 145,161 times 38%, the tax impact is 55,161. And let's go put that on our income statement. So what I'm saying then is the actual loss is 145,161. Normally, that's the information I know. So problem 1 was just a little odd, but it did not give us this amount in order to solve for the 90,000. It made us go in really odd sort of way backwards. But I do know this is the loss. I will take that times the company's 38% tax rate to get a tax benefit of $51,161, and those net to 90,000. Why don't you go and see if you can do the same thing for this 440,000. So the same thing for the 440,000. And I'm going to stop, work it through, and you can check to see if you got the right answer. Okay, so for the 440,000, ultimately that's going to equal 62% of the loss, because it's the net amount. Divide each side by 62%. This cancels out, and we have the loss equals 709,677. And then if I take that times my 38%, I'll get the tax effect to be this. So let's go back. That would be fully disclosed on the income statement. So it has 709,677, net of the tax, 269,677. Okay, and then that finishes out the income statement. The other thing that goes on the face of the income statement, so not only do we solve for net income, but down below that, we show earnings per share. And this does go on this page with the income statement. So earnings per share, basically earnings per share is really taking net income. And then if there is, and by the way, earnings per share is for the common shareholder. So if there's any dividend to the preferred stock shareholders, we remove that. So net income minus the preferred stock dividend. And then I would divide that by, I put it as if this was in Excel, I would divide that by the number of common stock shares outstanding. Outstanding, that's an N. Okay, so net income, remove any dividend going to the preferred shareholders, take that net income then and divide by the common stock shares outstanding. So income from continuing operations, we're going to start with it. So I start with this number, that 2,026,000. And back in the narrative, it does tell us there was a dividend on the preferred stock for 80,000. So I'm going to subtract that out. And also in the narrative in here, it's going to tell us there were 500,000 shares of common stock. So I take the net income less the dividend, divide by the shares outstanding, and I get this $3.89. So there's three major things. Income for continuing operations. We're also going to show these discontinued items. So that's this, 90,000 and 440,000. And I divide those by the common shares outstanding, again, net of tax, and so I get my discontinued operations. And the third major component for earnings per share then is net income. And then I'm taking that net income, again, subtract out the preferred stock dividend, divide by the shares outstanding to get that. So the three components of earnings per share we have listed here. Okay, and before we go on to the statement of retained earnings, I want to go back and revisit this idea of income tax expense. We actually have three income tax items. We have income tax expense here, and we have these two income tax benefits listed on the income statement. Let's scoot over to this page. If we were recording income tax expense then, for the expense paid on income from continuing operations, the $1,244,000, right? That would be a debit to income tax expense, and we would probably credit income tax payable or cash. So we would have, a debit entry to expenses and then some credit for cash or some income tax payable. Here, though, are benefits. So we're either, we're going to get cash back or it's debiting our income tax payable account. So here, we're actually going to be crediting the expense account for these because we get a benefit. Either, it probably isn't actually cash coming in as a debit. Truly, it actually is more going to be a debit to our income tax payable to reduce the liability, and we would credit the expense for those two amounts. So let's go over and show what that would look like. So we would have these three amounts in our income tax account. Then if I net all of those, the actual net expense is this amount, $919,162. So I just want to show you that it's interesting, I think, that the bottom line income tax expense, I don't actually see this number alone by itself on the income statement. It's the three components of it that we see on the income statement. Okay, let's do the statement of retained earnings. So they give us the beginning retained earnings, and again, that's just given in the narrative. I've gone ahead and added a couple of things. We actually will talk about these two adjustments in problem 3 when I demonstrate that, but I just wanted to go ahead and put them here so you have this in your notes. It could be that our beginning retained earnings is not accurate, that there might be an error in it, and if so, we may need to make adjustments to that beginning balance. So that can be done for a prior period adjustment, and again, that's when there has been an error in prior financial statements. It also could be if we change our mind about an accounting principle. So if we had been using an accelerated depreciation method, and I want to switch to straight line, we're to have a change in accounting principle, and we will go back and we want to change, if we change it, we've got to change it back from when we first bought that property, plant, and equipment, the asset. So we have to go back and restate earnings for those prior periods. And we'll get into that in problem 3. But anyhow, here we have our beginning retained earnings. We know the two major things. Profits cause it to go up. Dividends cause it to go down. And so we are merely taking our net income from this page. If you can, looking at the wrong number, aren't I? So we take our net income, $1,496,000, and I'll put that in here. And we subtract our dividends. Let's see, we can list those out. There actually were dividends for both preferred and common. We've already looked at the preferred of $80,000. Let's go take a peek. How much were the common dividends? $250,000. So if I add those together, I'll get $330,000. And of course, I subtract that, then to arrive at our net income. Excuse me, not net income, our ending retained earnings. Okay, so there is the basic income statement now here at the intermediate level. Here's the components of the income statement and statement of retained earnings.